You ever get the feeling when, like the financial news starts getting all doom and gloom,
Yeah.
like all the headlines are saying things are about to go south, and you just can't shake this feeling that, like,
Oh, yeah.
winter is coming, for the markets, I mean. So how do you deal with that? Like, how
Yeah.
do you build this solid foundation with your finances that gives you that lasting feeling of security and peace of mind, like
Yeah.
genuine peace of mind, no matter what craziness the market throws at you? That's got to be on so many people's minds.
It is. And it's completely understandable. When the whole economic climate seems to be shifting like that, it's normal to feel uncertain.
For sure. And that's exactly what we're digging into today on this deep dive. One of you actually reached out and shared some really interesting stuff with us from Tony Robbins' book,
Right.
Unshakeable. It's called Unshakeable, Your Financial Freedom Playbook.
I remember that one. I've heard good things.
Yeah. So we're going to try to like pull out the core wisdom from this book and give you guys some practical knowledge you can actually use so you can feel more informed. And ultimately, like the title says, unshakable about your financial future.
Makes sense.
It's interesting. That book really seemed to resonate with a lot of people. And,
It did.
one thing that I think is really worth pointing out is like the people who endorsed it, like big names in finance. You had John Bogle,
Oh, wow.
the guy who like pioneered those low-cost index funds,
Huge.
which is really relevant to what we're going to talk about today with like minimizing fees and all that. And then you had Ray Dalio.
Oh, of course, from Bridgewater. Yeah.
Yeah, he's
Yeah.
like a leading voice in understanding those economic cycles and, winter's coming and all that.
He knows all about that.
Oh, yeah. And it doesn't stop there. You had Mary Callahan Erdos from JP Morgan Asset Management, T. Boone Pickens, David Pottruck, even Kyle Bass.
Kyle Bass.
Yeah.
The guy who, basically predicted the whole subprime mortgage crisis.
That's him.
Yeah.
And made a killing off of it.
Yeah.
So when you see names like that all agreeing that this book is worth reading, it's like, all right,
Yeah, you got to pay attention.
there's going to be some serious insights in here. So our mission for this deep dive is pretty clear.
Lay it on me.
We want to pull out those key strategies and essential knowledge from Unshakeable and like really give you the tools to navigate the financial world,
Absolutely.
With more understanding and a stronger feeling of control. We're going to talk about how to understand those ups and downs in the market, which
Oh, yeah, they're always going to happen.
they're inevitable.
Yeah.
We're going to look at how fees can secretly eat away at your returns. There are all sorts of hidden fees out there.
All the time.
And then we're going to talk about why trust is so important and why having your own personalized financial plan is like essential. Okay, so let's unpack all of this. Let's start with something that's always on everyone's mind, those market swings.
Right. So, the book doesn't shy away from this whole idea that market corrections
Oh, yeah.
and even like those really big downturns.
Like the winter is coming moments.
Exactly. They're not like some weird exception. They're actually a normal part of how the financial world works.
They're predictable almost.
In a way, yeah. But here's the thing. What's really fascinating is that the book really emphasizes that trying to predict exactly when these downturns will happen
Yeah.
or exactly how bad they'll be is kind of like a fool's errand.
Absolutely. He actually talks about those smooth-talking TV pundits.
Oh, I know exactly who you're talking about.
And those Wall Street economists in their fancy suits acting like they've got some secret map.
They love to pretend they know.
But they don't. No one has a crystal ball. No one can perfectly time the market. And this brings us to a super important point from the book. He calls it Freedom Fact 4. It's so important. Basically, it says that despite those scary short-term drops, the stock market has always trended upwards over time,
Correct.
historically.
It's all about that long-term perspective. The book even brings up some really interesting data. Between 1980 and 2015, the S&P 500 had an average intra-year decline of 14.2%.
Whoa! That's a lot. Like, on the surface, that sounds terrifying.
It does, right?
Yeah.
But here's the thing. That's just the average drop within each year. Despite those drops, the market still ended up with a positive return in 27 out of those 36 years.
Seriously.
That's 75% of the time. So what does this tell us? Short-term volatility is just the price you pay for long-term gains.
So don't panic and sell everything when you see a dip.
Exactly. Don't let those temporary dips completely derail your long-term plan. If you step back and look at the bigger picture you see, the market is actually pretty resilient.
Okay, that's a powerful reminder to not just like react emotionally to every little market wobble,
Right.
But what about those bigger downturns, you know?
Ah, you mean bear markets.
Yeah, those. The book actually gives some good historical context here.
It does. And, understanding how often bear markets have happened in the past and how bad they've been can actually help you worry less about them.
For sure.
So if we go all the way back to 1900, there have been something like 34 bear markets.
Wow. So it's like one every 3 years?
Roughly, yeah. But if we focus on more recent history, like the last 70 years since 1946, it's been a bit less frequent.
Like one every 5 years or so.
Something like that. The point is, whether it's 3 years or 5 years, these downturns are just a fact of life when it comes to investing.
Right. So if you're in it for the long haul, you're almost guaranteed to see a few bear markets.
Definitely.
And the book actually talks about what those downturns typically look like. Like on average, how bad did they get?
So on average, the S&P 500 drops about 33% during a bear market.
Okay, so a third of its value.
Pretty much. But they don't last forever, thankfully. The average bear market lasts for about a year.
That's still a long time to be losing money, though.
It is. Even Jack Bogle, the index fund legend, he admitted that bear markets made him feel miserable. He said he'd get knots in his stomach. And you know what his strategy was for dealing with that?
What?
He'd reread books about staying the course.
So even the giants of the industry feel the pressure.
They do. But here's the key takeaway. And this is so crucial for your peace of mind.
What is it?
Bear markets always end eventually. And then what happens? This is where thinking long-term really pays off.
Okay, I'm listening.
So the book has all these examples from the past 70 years. It shows how the S&P 500 performed in the 12 months after it hit its lowest point in each bear market.
Interesting.
And you know what? The returns were huge, often way up in the double digits. Sometimes they even went over 50%.
Stick out here.
Seriously. History shows that after those scary downturns, there are often massive rebounds. That's why that stay the course advice is so important. It might sound simple, but it's like a key part of that unshakable mindset.
Right. It's like the financial version of spring always follows winter.
Exactly.
It reminds me of what Warren Buffett always says.
Oh, yeah.
Be greedy when others are fearful.
Love that one.
It's like when the market's down, that's when the biggest opportunities for long-term growth pop up.
Exactly. And it's about having the discipline to not only avoid selling low because you're panicking, but to actually think about buying when things are on sale.
Buy low, sell high. It's like the golden rule.
It is. All right, let's shift gears a bit and talk about something that can kind of sneakily eat away at your returns over time. Fees. Tony calls fees enemy number 2 in his book.
And he's not wrong. What I found really interesting is how he emphasizes that the cost of investing isn't always super obvious. There can be all sorts of hidden charges lurking around.
Okay, all the time.
And because of this thing called compounding, even tiny little fees can end up having a huge impact on your savings in the long run.
It's true. Think of it this way. Every dollar that goes towards fees is a dollar that isn't growing for you in the future. He uses this really vivid analogy in the book. He says that fees can chip away at your 401k balance like termites eating away at a house.
Oh, no.
And get this, the costs that come with some annuities can be as destructive to your financial future as Godzilla is to a city.
Oh, man. That's a scary thought. And the book really dives deep into those hidden fees in 401k plans, which is something that affects a lot of people listening.
A lot, yeah.
One thing I found really eye-opening was this idea of an extra layer of fees. Like, it's often totally invisible, but it can take a massive chunk out of your returns.
Huge.
Robbins talks about this study by Robert Hilton Smith, who found up to 17 different fees and costs hidden in 401k plans.
You're kidding.
For the average earner, this can add up to hundreds of thousands of dollars lost over a lifetime just from fees.
Hundreds of thousands, and it's all legal.
Apparently.
Man.
So I guess one of the big culprits here is this thing called revenue sharing or pay to play.
Yeah.
Can you explain how that works? Why is it bad for investors?
Okay, so it's basically this arrangement where 401k providers get paid by the mutual funds that are offered within their plan.
So the companies that make the mutual funds.
Right. And this creates a problem because now the provider has this incentive to include funds that make them the most money.
Gotcha.
Not necessarily the funds that are the best or the cheapest for you.
Right. So the funds you see in your 401k might not be there because they're good.
Exactly.
But because the fund company paid to have them included.
Think of it like a grocery store charging food companies for the best shelf space.
Uh-huh.
So you might end up with a bunch of junk food at eye level, even though it's not healthy.
And these types of funds, they tend to be actively managed funds, right?
A lot of the time.
With higher fees, naturally.
Of course.
And what's especially worrying is that it's harder for smaller companies to offer those low-cost index funds in their 401k.
Yeah. See, index funds, they typically have really low fees.
Right.
So they're not as profitable for the 401k providers. So the providers might just leave them out unless the company has a ton of assets in their plan.
That's messed up.
It is. Tony even shares this crazy example in his book. There was this big insurance company offering an S&P 500 index fund, but they were charging way more than it actually cost.
You mean they were marking it up like crazy?
Like crazy. Just because they could.
It's no wonder there have been all these lawsuits against these big 401k providers.
Oh, yeah. Tons of them.
For charging these ridiculous fees.
Yeah.
It's wild that even Tony Robbins himself found these super high fees in his own company's 401k plan. It just shows that this isn't just a problem for like everyday investors.
Right.
Even people with a ton of financial knowledge can get hit with these hidden costs.
It's scary.
All right, let's move on to something super important. Trust. Like, how do you know who to trust in the financial industry, especially with all the scandals and lawsuits and everything?
Yeah, it's tough.
How do you find an advisor you can actually trust?
It's a big question. And the book doesn't shy away from it. It talks about how much money financial firms have paid out in legal settlements.
Oh, yeah, and it's a lot.
It's insane. Between 2009 and 2015, 10 of the biggest financial firms in the world paid out almost $180 billion in settlements.
Wow, 180 billion with a B.
Yeah, and the 4 biggest U.S. banks were responsible for over 145 billion of that.
So that's like one scandal after another.
Pretty much.
No wonder people are skeptical.
Right, and it's totally understandable. But so how do you find someone you can actually trust? Well, the book makes this super important distinction between brokers and fiduciaries.
Oh, yeah, I've heard those terms thrown around. What's the difference?
So a broker is basically a salesperson. Their job is to sell you financial products. And legally, they don't have to put your best interests first.
Whoa, seriously?
Seriously. And a lot of them work on commission. So the more they sell you, the more money they make.
So there's a built-in conflict of interest.
Good time. On the other hand, a fiduciary is legally and ethically obligated to act in your best interest.
So their advice has to be objective and focused on what's best for you financially.
Yeah.
Exactly. But here's the kicker. Most financial advisors are actually brokers. Like around 90% of them, according to the book.
90%. So there's a good chance you could think you're getting unbiased advice when you're actually talking to someone whose main goal is to make a commission.
That's the scary part.
And then the book brings up this thing called dual registrants.
Oh, yeah, that's a tricky one.
Can you explain what that is and why it's a red flag?
Okay, so a dual registrant is basically an advisor who can switch back and forth between acting as a fiduciary and acting as a broker.
So sometimes they're legally bound to give you the best advice, and sometimes they're just trying to sell you stuff.
That's the gist of it, yeah.
Yeah.
It creates this huge conflict of interest. You never really know which hat they're wearing at any given time.
That's super shady.
It is. So if you want to find a real fiduciary, someone who's actually legally obligated to put your interests first.
Yeah. What should you be looking for?
So the book lays out some good criteria. First of all, you want someone with a strong commitment to that fiduciary duty and a high level of expertise. So they have to be both ethical and competent.
Exactly. Credentials like Certified Financial Planner, CFP, can be a good sign. Yeah. And a good fiduciary should offer more than just investment advice. They should help you with things like your mortgage, insurance, taxes, estate planning, the whole shebang.
Like a one-stop shop for all your financial needs.
Right. It's also good if they have experience working with clients in similar situations to yours. And finally, you want to make sure their financial philosophy aligns with yours. Like, do they believe in actively trying to beat the market? Or do they prefer a more passive approach with index funds?
That'd be a good fit.
Absolutely. The book actually mentions this firm called Creative Planning, run by a guy named Peter Mallouk. It's an example of a firm that operates without those commission-based conflicts.
So they're truly fee-only.
Yep. And they offer a whole range of services even for people who only have like $100,000 in assets.
That's awesome. So finding the right advisor can really make a big difference. Okay, now let's get into the meat of the book. Building your own Unshakeable playbook.
Let's do it.
And understanding those core 4 principles for investing success.
So this is where the book goes from explaining how things work to giving you actual strategies you can use.
Right. Give us the goods.
Okay, so the core 4 principles are like the foundation for creating a solid investment strategy that can handle anything the market throws at you.
Okay, I like it. What's the first principle?
Principle number 1 is don't lose.
That sounds pretty basic.
It does.
Yeah.
Right. But the book really stresses why avoiding losses is so crucial for your long-term financial health.
Okay, I'm all ears.
So it all comes down to math. If you lose 50% of your investment, you actually need a 100% gain just to get back to even.
Oh, wow. Yeah, that makes
So
sense.
it's not symmetrical. This is why protecting your money and avoiding big losses is so important.
So it's not about being totally risk averse. It's about being really smart about the risks you take.
Exactly. The book actually talks about this guy, Paul Tudor Jones, and his 5-to-1 rule.
What's that?
So his rule is that he aims to risk $1 with the potential to make $5.
Right.
So even if he's wrong, most of the time, those few big wins can still put him way ahead.
So it's like swinging for the fences, but only when you've got a really good chance of hitting a home run.
Exactly. And Richard Branson's another great example. He's all about protecting the downside.
Makes sense. And Carl Icahn.
He talks about really understanding both the potential risks and rewards before you invest in anything, like really doing your homework.
You got to know what you're getting into.
For sure. And this actually ties into Warren Buffett's whole strategy of buying those undervalued companies during market downturns.
Oh, yeah, that's classic Buffett.
So the idea is that when prices are really low, there's less downside risk. But when the market recovers, those gains can be massive.
Like buying a house on sale?
Exactly. And he did this with Goldman Sachs and GE during the 2008 crisis. Tony Robbins even shares his own story about a trust deed investment where he limited his potential loss but still got a really good return.
So it's like calculated risk-taking. Okay, so principle number 1 is don't lose. Principle number 2 is asymmetric risk-reward, which we kind of just talked about.
Right. Making sure your potential gains are much bigger than your potential losses.
I like it. What's number 3?
Number 3 is tax efficiency.
Taxes.
Yeah, it's easy to overlook, but the book makes a strong case that it's crucial. It's not just about how much you make, but how much you get to keep after the government takes its share.
Tell me about it.
So the difference between short-term and long-term capital gains taxes can be huge. Basically, if you hold on to an investment for longer than a year, you get taxed at a lower rate.
That's good to know.
The book shows how high fees and constantly trading can actually hurt your after-tax returns because you end up paying more in taxes.
Interesting.
And they strongly recommend taking advantage of tax-advantaged accounts like 401ks and Roth IRAs.
Yeah, you got to max those out whenever you can.
Absolutely.
Yeah.
They even quote David Swensen, the guy who manages Yale's endowment fund. He says it's super important to use every tax-advantage opportunity you can get.
Smart guy.
Oh, yeah. And get this. The book points out that a lot of brokers can't even give tax advice. So it's even better to work with a firm that has CPAs on staff.
So you can get all your ducks in a row.
Exactly. Tony Robbins actually talks about his own experience living in California, which has pretty high income taxes.
California taxes are no joke.
They aren't. And he says that made him think a lot about how to minimize his taxes and make his investments more efficient.
Makes sense.
The book even mentions these things called master limited partnerships, or MLPs, as a way to invest that can have some tax advantages.
Interesting. So being smart about taxes is a big part of investing.
Huge.
Okay, so we've got don't lose, asymmetric risk reward, and tax efficiency. What's the 4th and final principle?
The final one is diversification.
Yes. I've heard that one a lot. But why is it so important?
Okay, so basically diversification is your shield against the fact that no one can predict the future. By spreading your investments across different things, stocks, bonds, real estate, even different countries.
Don't put all your eggs in one basket.
Exactly. You reduce your risk if any one area tanks.
It's building a strong foundation.
Right. So if one part of your portfolio takes a hit, the whole thing doesn't crumble.
That's a good feeling.
It is.
All right, so to recap, the core 4 are don't lose, asymmetric risk reward, tax efficiency, and diversification. Seems like anyone can understand and use these principles.
They absolutely can.
So as you guys think about this deep dive into Unshakeable, think about this. Which of these principles are you maybe not paying enough attention to in your own financial life? And what's one thing you can do starting today to incorporate that principle into your plan?
Good questions.
It's all about taking this knowledge and actually using it.
Right. Taking action.
To build a more secure and resilient financial future for yourself. Thanks for joining us for this deep dive.
My pleasure.
And remember, stay unshakable.